Hello intelligent investors, this is Victor here. As you may already know, growth stocks have recently crashed. Many investors who have invested in growth stocks are concerned about the US stock market and want to know what are the best strategies going forward. On November 4th, right before the current growth stock crash, I wrote this post for all our members. I said, the market is exceedingly greedy now. Here's the fear and greed index, meaning most US stocks are substantially overvalued. I think it's a good idea to wait for pullbacks, hold more cash, and stay away from overvalued stocks going forward. The market cannot always go up this fast. There will always be corrections, large market dips, especially when the market is overpriced. So I think it's important to be prepared with a lot of cash. The best time to buy in is when the market has a large correction. For example, during the peak of pandemic in March 2020, so most stocks will become undervalued. The US stock market is very fearful now, as represented by this fear and greed index here. This means many US stocks have become undervalued. In this video, you will learn about these two important topics. First, why did growth stocks crash? You will learn about the main reasons that have caused most growth stocks to crash recently. And second, how to turn your growth stock portfolio around. You will learn about the 7 steps that will help turn your growth stock portfolio around. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. So why did growth stocks crash recently? There are several major reasons. The first main reason is that there's the new Omicron COVID variant that was recently discovered in South Africa. Many investors are concerned that the new Omicron COVID variant will spread to many countries including the US, the European countries, and the Asia Pacific countries. If the new COVID variant continues to spread, countries will close their borders. There will be more travel restrictions which will affect many businesses around the world. In my opinion, I believe the market overreacted to this new Omicron COVID variant. The second main reason is that the US Fed is planning to taper its $120 billion monthly quantitative easing QE program much earlier than before because the current high inflation rate in the US is no longer transitory. This means the current high inflation rate in the US is lasting much longer than the US Fed initially expected. For example, the US PCE inflation rate is at 5% as of October 2021. This PCE inflation rate has been increasing every month since the pandemic started. It's much higher than the US Fed's average 2% target inflation rate. In my opinion, the current high inflation rate in the US is definitely not transitory. If we look at how much energy prices, home prices, food prices, commodity prices, and new and used car prices have increased in North America. Many companies in North America have a hard time hiring more employees because many people are quitting their jobs to look for other higher paying jobs or to start their own businesses. This is another sign that the current high inflation rate in the US is not transitory. The US Fed is much more hawkish now. This means the US Fed is much more concerned about fighting inflation risk instead of printing more money and maximizing employment in the US. According to this article here, Fed Chairman Jerome Powell, who earlier this week said the central bank will likely in its next meeting discuss speeding the unwind of its $120 billion per month government bond buying program. Powell also said the word transitory was no longer appropriate to describe the current high inflation rate. Stronger than expected elements in Friday's US employment report reinforced the view of a more hawkish Fed and weighed on growth stocks. The US Fed is expected to increase its Fed funds rate much faster after it ends its tapering in 2022. This means the cost of borrowing for consumers, businesses, and corporations will increase faster going forward. When interest rates increase, mortgage rates and loan rates for consumers will increase. Business loan rates and consumer loan rates for businesses will also increase. In my opinion, the US Fed tapering and interest rate increases will likely have a large impact on growth stocks going forward because many growth stocks' underlying businesses do not have consistent cash flows yet. Many of their businesses are still losing a lot of money every quarter. This is why growth stocks have recently crashed. Growth stocks tend to do very well when interest rates are low. This is why Cathie Wood's ARK ETFs have underperformed the S&P 500 substantially this year. Most of the companies within ARK ETFs are disruptive companies that are still losing a lot of money every quarter. Valuation does matter, especially when interest rates are expected to increase. The third main reason growth stocks have crashed recently is that most growth stocks were substantially overvalued before. I always use this fear and greed index to find out whether the US stock market is currently overvalued, meaning very greedy, fairly valued, meaning neutral, or undervalued, meaning very fearful. The best time to buy stocks is when the market is very fearful, because most stocks will be undervalued, and the best time to sell stocks is when the market is very greedy, because most stocks will be overvalued. For example, on November 4th, when the Fear and Greed Index was very greedy, I wrote this post for all our Patreon members explaining why I believe the US stock market was substantially overvalued. I said, the market is exceedingly greedy now. Here's the Fear and Greed Index, meaning most US stocks are substantially overvalued. I think it's a good idea to wait for pullbacks, hold more cash, and stay away from overvalued stocks going forward. The market cannot always go up this fast. There will always be corrections, large market dips, especially when the market is overpriced. So I think it's important to be prepared with a lot of cash. Now, most growth stocks have crashed at the time of making this video. The lesson here is that valuation does matter. When the market is very greedy, it's best to wait for pullbacks, hold a lot of cash, sell some shares of overvalued stocks to have more cash, and wait for the market to become very fearful again, so you can buy more outstanding stocks that are undervalued. The fourth main reason is most likely sector rotation at the end of the year. Most fund managers and hedge funds are likely rotating their investments from growth stocks to value stocks and to other sectors such as consumer staples that will perform better when the inflation rate is high and when interest rates start to increase. Obviously, no one can predict what the largest fund managers and hedge funds will be doing next or what sectors they will be investing in next. In my opinion, it's best to have the right strategy going forward if you want to grow your portfolio consistently over time. Let's talk about the 7 steps that I believe will help grow your stock portfolio over time. The first step is to have a lot of cash when there's a large market correction, so you can buy more outstanding stocks that are substantially undervalued. I always say this, cash is king during a market correction. The stock market is always in a mood swing. One week, it can be very optimistic and greedy. The next week, it can be very pessimistic and fearful. As of now, if you look at this Fear and Greed Index, you can see the market is very pessimistic. Growth stocks have crashed recently. This means many growth stocks are much more undervalued now. Warren Buffett wrote this in his 1986 shareholder letter. Our goal is more modest. We simply attempt to be fearful when others are greedy and to be greedy when others are fearful. Warren Buffett also said this before, a market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. Obviously, if you have a lot of cash now, you can start buying shares of many outstanding businesses that have become undervalued. If you don't have a lot of cash now, a very good strategy is to start cutting down your monthly expenses and to save at least 10% of your gross income every month, so you can have more savings to invest going forward. For example, if you look at my main growth stock portfolio here, it's currently at 651,000 at the time of making this video. 6 months ago, when I made the first growth stock portfolio analysis video, this portfolio was at 530,000. This portfolio has increased a lot in value this year because I invested in many outstanding businesses, including Apple, Google, Microsoft, Nvidia, AMD, and Tesla. The winners in this portfolio more than offset the losers even during this large growth stock correction. Personally, I want to take advantage of this large market correction. What I do is to keep saving a minimum of 10% of my monthly income and keep buying more shares of outstanding businesses that I believe are undervalued. I like to be greedy when others are fearful. The second step is to keep buying great stocks gradually to build a portfolio instead of buying stocks all at once. Buying stocks all at once, in my opinion, is a common mistake because you will run the risk of buying stocks when their prices are too high or are near their peaks. It makes sense to buy stocks all at once when the S&P 500 is in a large market correction, but you have to be very good at timing the market and finding the bottom. For example, during the peak of the pandemic in March 2020, the S&P 500 index represented by the SPY S&P 500 ETF was down as much as 32%. That was the best time to buy more stocks because most stocks were substantially undervalued. The problem is that no one can predict where the bottom is. This is why I believe a much better approach is to buy shares of outstanding businesses gradually instead of buying stocks all at once. For example, when I first started investing many years ago, I did not have $50,000 to invest or $100,000 to invest. After graduating, I only had $5,000 to invest. I had to save a portion of my income every month. I kept buying stocks gradually whenever I saved $1,000 to $2,000. I still follow this strategy to keep buying outstanding stocks gradually now. The third step is to build a portfolio consisting of top 20 best companies that have increasing earnings, increasing economic modes, great cash flows, and trustworthy management. Obviously, you will have to do your research and do your extra due diligence before investing in any stocks or any investments. If you take the time to do your research first and always invest in what you know, meaning only invest in companies you understand the most, you can find many outstanding businesses around you that have increasing earnings and increasing economic modes. Personally, I believe a very good strategy is to build a portfolio with top 20 companies that have strong fundamentals, increasing earnings, and increasing economic modes. You can have top 20 companies or top 25 companies in your portfolio, depending on your portfolio size. I believe having the top 20 stocks in a portfolio is optimum because it is still manageable for most people. If you have too many stocks, let's say 50 stocks in a portfolio, you will likely have a hard time following all the latest news and being an expert in all their businesses. For example, I currently have top 25 stocks in my growth stock portfolio here. Not all of them are winners. The biggest losers are Alibaba and Tencent Holdings. The good thing is that the biggest winners more than offset the losers. For example, just my gain in Alphabet is more than enough to offset all the losers. If you build a portfolio gradually consisting of top 20 companies that have strong fundamentals, increasing earnings, and increasing economic modes, you will eventually have a winning portfolio with many multi-bagger stocks. The multi-bagger stocks often offset the losing stocks. The fourth step to building a winning stock portfolio is to find outstanding businesses around you that are likely undervalued. This is the hardest step because you will need to do a lot of research on stocks, understand their businesses and their competitive advantage, understand their products and services, predict their future growth prospects, and understand their risks. If you're a value investor, you will need to estimate each stock's fair intrinsic value so you will know when the stock is overvalued, fairly valued, or undervalued. If you're a long-term investor, investing in stocks is the same as investing in businesses. Stocks are representations of businesses. In the long run, stock prices always move according to company earnings and business fundamentals. In the short term, stock prices always move up or down depending on market sentiments known as greed and fear. Benjamin Graham said, "In the short run, the market is a voting machine. In the long run, it's a weighing machine." So how do you find great businesses around you? Here are several examples. If you look at my growth stock portfolio here, there are several big winners this year. For example, I bought Tesla stock before the stock split and before it joined the S&P 500 index. I decided to buy back my Tesla shares last year when I saw there were many people buying Model 3. I saw more and more people were driving Model 3. 2 months ago, I bought more Roblox shares when the stock dropped below my fair intrinsic value of $76 per share. The stock is up 55% after Roblox released its latest earnings. I decided to buy Roblox shares because I realized Roblox is a very popular online metaverse platform among kids under 13 years old. If you want to find outstanding stocks, the key is to find great businesses around you by noticing what everyone is buying and using the most every day. For example, if you notice that everyone is using the Google search engine and watching YouTube every day, you may find out Alphabet, the parent company of Google, is an outstanding business with increasing earnings and a large economic moat. Of course, you will need to do your own research on the company and do your extra due diligence first before investing in anything. The fifth step is to stay away from stocks that are substantially overvalued and stocks that are overhyped, because overvalued stocks tend to have larger corrections when the market crashes. Back in 2020, most growth stocks such as Zoom, Peloton, and DocuSign increased substantially in value because the pandemic forced everyone to stay at home, to work from home, and to work out at home. Many pandemic stocks crashed recently because their businesses are no longer benefiting from the pandemic as much as before, and because they were substantially overvalued. Also, many growth stocks crashed recently because of their high valuations, the current stock rotation, rising interest rates, the high inflation rate in the US, and the current US Fed tapering that will likely accelerate. Going forward, I believe it's important to stay away from companies that are substantially overvalued because they will be impacted the most when there's a large market correction. Companies that are still losing a lot of money and burning a lot of cash every quarter will be impacted the most when the US Fed tapering accelerates and when interest interest rates start to increase. The sixth step is to sell the losers that are no longer outstanding businesses instead of waiting for them to recover. I made many investing mistakes in the past. I actually learned the most from my mistakes. For example, if you look at my main growth stock portfolio here, you can see my biggest losers are the Chinese stocks, including Alibaba and Tencent Holdings. In my opinion, they are outstanding businesses, but their valuations have dropped substantially this year because of the current regulatory crackdowns in China, the ongoing geopolitical issues between the US and China, and Chinese stocks' potential delisting going forward. I will make a video about Chinese stocks' potential delisting very likely next week. If you look at this realized gain and loss history here, you can see I sold my Pinduoduo shares at a large loss and my ARK ETFs at a large loss last week. I made the mistake of investing in Pinduoduo stock near the peak even though I knew Pinduoduo was substantially overvalued compared with Alibaba and JD.com. I also made the mistake of investing in ARK ETFs near the peak without doing enough research on ARK ETFs first. I always do a lot of research on stocks, but I was fear of missing out, FOMO, on Pinduoduo and ARK ETFs. I had two options. The first option was that I could wait until Pinduoduo and ARK ETFs to recover, but this may take them several years. The second option was that I could sell Pinduoduo and ARK ETFs at a large loss and reinvest the capital in other US stocks that are outstanding businesses and that are undervalued. I chose the second option because I can reinvest the capital in other outstanding US companies that I believe are undervalued, especially after growth stocks have recently crashed. The positive thing is that the winners in my portfolio more than offset the losers. For example, just the gain from the Alphabet is more than enough to offset the losers. My plan is to keep investing in the winners that are outstanding businesses and keep buying their shares when they become undervalued. The seventh step is to stay invested for the long term and let your stock portfolio grow over time. I believe it's much more important to stay investing at all times through all the market ups and downs instead of timing the market, because no one can time the market right all the time. Another reason to invest for the long term is that US stocks, as represented by the S&P 500 index, tend to do very well over the long run because of the US economic growth and because of the S&P 500 companies earning growth over the long run. Warren Buffett said the real fortunes in this country have been made by people who have been right about the businesses they invested in and not right about the timing of the stock market. If you look at my growth stock portfolio here, you will see that it has many multi-baggers, including Apple, Adobe, Amazon, Alphabet, and Microsoft. They did not become multi-baggers overnight. They have become multi-baggers mainly because of their underlying businesses and their increasing earnings over the long run. Based on my experience, I found that long-term investing is much better than short-term investing because long-term investing tends to have much lower risk. Also, if you invest in the right businesses such as Tesla and Nvidia, these outstanding businesses tend to have the biggest gains in the long run. Now, as always, make sure you always do your research and do your extra due diligence first before investing in anything. Don't invest in anything you do not understand. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.